We're going.
All right, students. Sorry this is so late. This is Friday night. Gonna try to get this uploaded before too long. Well, I want to start with problem 22. And this goes to the definition of amount realized. And my amount realized is the total amount that I get from a sales transaction, which would include cash and other property and everything, minus my selling expenses. And so 22A, Herbert sells some land that he owns to Elroy in exchange for $23,000 in cash. And two breeding hogs worth $1,500 a piece. So that's $3,000. So that's $26,000. In closing the sale, however, Herbert incurs legal fees of $600, title search costs of $250, and document filing for $50. In other words, he has $900 of selling expenses, so his amount realized is $25,100. Just as a side note, Elroy will have a $2,000 gain on the sale of the hogs because they are worth $3,000, has a base of $1,000, so he's going to have a $2,000 gain on those hogs. Okay, part B. Corporation sells a building it owned to Paris, who finances the purchase by obtaining a $200,000 loan and paying an additional $20,000 in cash. So here's $220,000. As part of the sales agreement, S agrees to pay the $4,000 in points. So that would be a selling expense, $4,000 in points, and an additional $17,000 in the $12,000 and the $5,000 in legal fees and commissions. So my amount realized would be $199,000. Part C is just $51,000. One person received land worth $51,000. The other person received land worth $46,000 plus $5,000 cash. So for both of them, the answer is $51,000 is their amount realized. And part C is this $22,000 plus the assumption of the mortgage of $90,000. When somebody else takes your debt, that's the same as if you're receiving cash. And so in part D, it's $112,000, the 22 plus the 90. Okay? Now I want you to remember that this is just the amount realized calculation. What we're going to take from these amount realized amounts is we're going to take then our adjusted basis in order to calculate what the net gain is. All right, let's look at problem 26. I had one of you write me a note saying that they could not understand 26. So let's see what we can do about 26. 26 part A, sells land to Gerald for which it paid $32,000. 26. Jorge owns 800 shares of stock. He purchased 300 shares for $9,000 and an additional 500 shares for $10,000, if I remember this right. Yep. During the current year, Jorge instructs his broker to sell 400 shares. Well, because these shares have a different basis, we have to decide which one of these 400 shares we buy or we sell. Well, the rule is really simple. There's only two inventory methods that we use when we're talking about stocks. One is FIFO, first in, first out. The second one is specific identification. So in other words, if I call up my broker and say, hey broker, sell the shares that I purchased on July 7th, we would use the shares that I purchased on July 7th. But if I call up my broker and say, hey broker, sell 300 shares of IBM stock, then we use the first in, first out method. And so that's exactly what happened here, is he just called up and said, sell 400 shares. Didn't identify which one, so we use first in, first out. So that makes this problem pretty easy. We have 300 shares that we sold for $9,000. 100 shares that we then sold for $2,000. That gives me a basis of $11,000 in these shares. Now, what I have to do now is we then sold these shares for $29 a share times 400 shares, and I believe that is $11,600. We then had selling expenses of $300. The commissions gives me an amount realized in of $11,300 compared with my basis of $11,000 gives me a $300 gain. And that's part A. Not too hard. Okay. Part B. Elena owns 300 shares of Courtney common stock that had cost her $6,000. On February 1st, she sells the 300 shares for $4,800. So we're going to take 6,000 minus the 48 selling price gives me a $1,200 loss. This is basis sales price. But then something funny happens here. On February 19th, Elena purchases 500 shares of Courtney common stock for $5,300 plus a $400 commission. So that gives us $5,700 total. But she purchased them within, remember we had this wash sale rule that says that if we sell stock and 30 days before, 30 days after we purchase the same shares, that it's a wash sale and we cannot recognize a loss. If it's a wash sale that produces a gain, we recognize the gain. But if it's a wash sale that produces a loss, that gets deferred. And we're going to add that basis then into the new stock that we purchased. So, but here this is 500 shares. Our wash sale shares are only 300 because that's what we sold up here is 300 shares. So we got to do an allocation here. We're going to take 300 divided by 500 times 5,700. Let me check my notes. That is going to be, let me go back here. There was also $300 of commissions here, producing a total loss of $1,500. So we're going to take 300 divided by 500 times 5,700, which gives me $33,420. This loss now gets added to the basis of these wash sale shares. So this becomes, we're going to add this $1,500 down here to give us a basis in these 300 shares of $49.20. I also should say that the holding period on these begins with the original purchase of the wash, with the original purchase. So if they were purchased 3 years ago, my holding period would begin 3 years ago. Okay? Now we're going to do the same thing for the 200 divided by 500 times 5,700 is equal to 2280. So I'm going to have 200 shares that have a base of 2280, 300 shares that have a basis then of 4920. Because this is a wash sale. And that's what we have to do on a wash sale is if it's a loss, we have to take that loss, add it to the basis of those wash sale shares. Okay, so here they really have two blocks. One with a holding period that begins when I purchased these, and this block that has a holding period that begins on the day after I purchased these shares. Okay, so that's B. C and D are actually fairly easy problems. Let me just talk you through C and D. Remember back in chapter 2, we had this concept of realization. That if I own a home and my home increases in value, that does not produce a gain just because my home increased in value because there's been no realization. Same applies to basically everything. Until I sell something, until there's a transaction, I don't have to recognize the gain. And so that's what happens in C. Goes to a flea market, finds a painting, pays $20 for it, discovers that it's worth at least $20,000. Well, there's no gain, not until there's realization. Now, what could happen, let's assume that rather than a painting for $20,000, there's a painting for $20,000 and there's $10,000 cash hidden in the painting. If there's cash, then I have to recognize gain to the extent that I receive cash. That's deemed to be realization if there's some cash that I get. Okay? And then part D, remember we talked about how if I give an easement to land and I get cash for that easement in the land, there is no gain that I have to recognize on it. The only thing that I have to do is reduce my basis in that particular piece of property. All right. 33. Let me just talk you through 33. Classify each of the following assets as ordinary income property, capital asset property, section 1231 property, or personal use property. More than one classification is possible. All right, Sarah's a sculptor. During the current year, she gives one of her statues to a niece as a gift. One of the things that would be helpful is if we turn to page 11-8 and 11-18. So let's turn to 11-8. And on page 11-8 is the definition of capital assets. And notice the definition of a capital asset is everything but. Everything but. An inventory item, a receivable, real or depreciable property used in a trade or business. Now, that one, we're going to come back to item number 3 when we go to 11-18. But number 3 is the definition of section 1231 property. Okay. A copyright held by a person who received the property as a gift from the creator. So this person that received this gift from the creator has ordinary income property. They have to recognize ordinary income if they ever sell it. If they, however, they go out and buy this particular item, then it's a capital asset to them. But here, this was given by the creator, and therefore it's ordinary income property. Patents, secret formulas, transferred basis created, same thing, same analysis in certain U.S. government publications would be, remember we talked about Richard Nixon and his memoirs that he donated to a university, and he wanted to get a fair market value basis in it, and Congress changed the law to make it so those memoirs would not be capital gain property, but would be ordinary income property. So on that last one, you can put, that's a Richard Nixon amendment to the code. Okay, so now then let's go through these. 33A, Sarah's a sculptor. Current year she gives one of her statues to her niece as a gift. Look, that's going to fit within item number 4 on 11-18. Petrus sells facsimiles of Greek artifacts. Because he has a cash flow problem, he sells some accounts receivable. That's going to be item 2. It doesn't make any sense to say that if I sell it and receive cash, it's ordinary income, but if I sell the receivable, it's capital gain. That makes absolutely no sense. So whether I get the cash immediately or whether I get it 30 days from now, it's ordinary income. Len is a college professor. She owns an apartment building and rents apartments to students. This would be production of income property and therefore a capital asset. Number 4, Ryan uses his automobile 75% for his job as a real estate person. That would be real or depreciable property used in a trade or business. That would be section 1231 property. Look at 11-18. And the other 25% would be a personal use asset and therefore a capital asset. Fred owns a used car business. He buys some land across the street. Again, this is not real or depreciable property used in a trade or business. At some point it may be used in a trade or business, but right now it's not. And so it's going to be a capital asset until the time in which he converts it to using it in his trade or business, at which point it will then become a section 1231 asset. Gets a tip from a friend that a new golf course is being developed south of town, so she buys a bunch of these lots. Now, the classification of this depends on what Athena does. If Athena is a developer, then these lots would be inventory to her, and because they're inventory to her, they would be ordinary income property. But if she's not a developer, if she's just an investor that at some point is going to sell these lots, then they would be capital assets. All right, so that is 33. 36. The way you have to handle a problem like 36, and I'm not going to work all the way through it, but the way you have to handle a problem like 36 is take all the sales and then go back using the FIFO rule. Look at all the sales and then go back and look at what the basis is then in those assets that just got sold. The other thing you have to look for is a wash sale. And here there is a wash sale. If you'll look at the Horton Inc., you'll see that the Horton Inc. is in fact a wash sale. And if it's sold at a loss, again, you'll have to add the basis then to the new shares that were purchased. And I think I'm going to start with 58 on Monday. So if If you have questions, please let me know. If you have questions, please email the whole class. Use one of the emails I've sent to you or that I'm going to send to you, letting you know that this has been uploaded, so the whole class can gain the benefit of your question. So with that, have a good night, have a good weekend, and be safe. Bye.